Okay, everyone, this is literally worse than expected, and we gotta go through some more details because there's even more crap. Like, this is literally tax the rich and kill the middle class's opportunities to build wealth. It's pretty freaking bad. Just before I get into this, though, this video is sponsored by Deal Machine, so that way, if you want to make sure that you get deals under market value and you get them off market with real estate, go to metkevin.com/deals, sign up, start sending some mailers directly to the sellers before they go to sell. Tell them you want to buy before they sell on the market, so that way you can try to get a below market value price. Go to metkevin.com/deals to check out how Deal Machine automates this for you. All right, problemo number one. If long-term capital gains taxes go away for people making over $1 million, 99% of people watching this video are like, that's okay, I don't care about that. You actually do. Now, we've talked about this regarding stocks, but this video is about real estate. So what happens when a long-term real estate investor does not get the benefit of basically having lower taxes on a long-term real estate investment? Well, if they're making over $1 million and they look at their real estate portfolio and they're like, do I want to sell anything? Oh, wait a minute. I have to pay ordinary income taxes on my gains on my real estate, and I have to pay state taxes on top of that? What? I took the risk on real estate and I'm going to pay 50 to 60% to the government if I sell? Screw that. I just won't sell. I believe problem number one is that when you tell people making over $1 million that you do not get a benefit for long-term holding real estate, it's just going to turn into, fine, I'll just hold it longer. Real estate is not something, unless you're flipping, that you're going to go in and buy and sell really quickly anyway. And in that case, you're slightly speculating and flipping at the same time by doing repairs to properties. But flips are taxed at ordinary income tax rates anyway. So there's no long-term benefit on a flip within a year anyway. You don't get long-term tax breaks there. The big problem, though, again, is larger real estate owners with larger real estate portfolios are going to be disincentivized to sell their real estate if they're going to get slapped with ordinary income taxes. They might wait or postpone when they sell property to when their income goes down substantially under $1 million. Maybe when they retire or whatever, leading a lot of real estate to stay in people's portfolios longer, which means otherwise people who might say, you know what, let's sell some real estate, let's diversify and get into stocks or whatever, are now potentially going to have less of a reason to sell and more of a reason to just say, you know what, why would I sell? I'll just hodl. That hurts housing inventory for everyone. It's bad for everyone who wants to buy a house. It's good when investors have low tax implications for selling because it gives them options. It lets them say, hey, you know what? Let's liquidate some assets here. Let's either pay some long-term capital gains taxes or we'll exchange into something else and we transact. And there's less of this need to long-term hold forever because you're not constantly getting taxed every time you trade. Big problem, especially since, real estate is a slower moving animal. So, you don't want to wait 10 years and then all of a sudden give up 60% of your gains on your real estate investments. You may as well, if you're still making good money 10 years down the road, as these millionaire investors probably will be, you may as well just keep the real estate rather than take a 60% haircut on all the gains that you've just been trying to accumulate over time. You're better off doing what I recommend in the real estate investing course linked down below. Over and over again, we talk about this. When the numbers make sense, and we talk about how to make sense of this, how to negotiate loans, how to do all of this, talk about all of this. When the numbers make sense, it's better to just do a cash out refinance. Guess what? You still own the property. Now you have access to the cash without paying taxes. So in other words, removing the long-term capital gains benefit, the benefit of lower taxes for wealthier individuals, means those wealthier individuals who also own real estate are less likely to sell their real estate, which means less housing on the market. Less housing on the market means higher prices for the person trying to get started today. This is a big, big problem. Now, problem one wouldn't ordinarily be so bad because in real estate, we've always had this beautiful thing called the 1031 tax-deferred exchange. Now this, it's very important to remember, only applies to investment real estate. I posted a brief video introducing this morning, but I want to go into more detail in this video. So the 1031 exchange does not apply to your primary residence. Let's get this very, very, very clear here. When you own real estate that you live in, you get a completely different set of tax benefits. For example, if you own a house that you bought for $100,000, and let's say 10 years later, the thing is worth $500,000, and you go to sell that property that you're living in and you're married, you get up to the first $500,000 in gains tax-free when you sell. This is called the homeowner's exemption. Up to $500,000 in capital gains free if you're married, up to $250,000 free if you're single. And you can even use that rule if you sell up to about 3 years after you've moved out of the property. So you could literally live in a property, move out of it, rent it for 2.5 years, and then sell it and still take advantage of these benefits, because the rule is you get to exclude $250,000 to $500,000 of capital gains on a house that you lived in for 2 of the last 5 years. If any of that was confusing, just go back and re-listen to that. The point is, this is not so heavily focused on primary real estate that you're living in yet. Don't worry, primary real estate is about to get smacked as well. It's all about to get smacked. This is so bad, and it's so bad for people trying to build their wealth. But anyway, problem number 2. So remember how I said, hey, if investors have a way not to pay taxes, they're more likely to sell, or if they can take the benefit of lower taxes, they're more likely to sell. The 1031 tax deferred exchange was the perfect solution for that. It meant that people who have rented out real estate, generally for at least 2 years, are able to take that, let's say it's a fourplex, and sell it for a property that's equal or greater in value in general, so that you're not paying taxes. Otherwise, you'd be paying taxes. So for example, if you're like, hey, I'm going to do a like-kind exchange from a 4-unit apartment building to a 20-unit apartment building, from $500,000 to, I don't know, $2 million or $3 million, whatever it is. Generally, you're going up in value and you're exchanging into bigger real estate. What you're doing is you're taking the capital gains from your first property and you're including those into the second property, so that eventually, when you finally cash out and actually take your money, that's when you pay taxes. But the problem is Joe Biden is getting rid of the 1031 exchange, in part by limiting it just to $500,000. Now you might be wondering, okay, well, how does that affect a normal person? Well, here's one example of how it affects a normal person. Let's say somebody's a retired person who bought a rental property when they were 40 years old and now they're 70 years old, and they bought a house in San Francisco for $200,000 that's now worth $1 million. So $200,000 became $1 million in San Francisco. That's a great gain. Let's say they've now fully depreciated it, so they've got $1 million-ish in capital gains to pay taxes on. If they now decide, you know what, I'm gonna sell and buy something else, they'd have to pay taxes. They could 1031 exchange half of it into a new property. The other half, they'd have to pay taxes on. They could still use the leftover to help contribute towards their next purchase, but they'd have to pay taxes on that portion, which for many people is going to turn into the smaller time investors, the many mom and pop real estate owners who have owned real estate for the last 30 years to go, what the heck? I don't want to realize those gains right now. I don't want to pay taxes on that. Fine, I'll just hodl longer. Doesn't matter to me. We'll just hold it even longer. That's bad because, again, less supply of real estate drives prices up. But what is the more sinister problem? Well, the more sinister problem is how it's going to affect LLCs or potentially even corporations or other entities or larger syndications who are buying real estate. Now, there are certain real estate funds that just buy real estate, they flip it, they pay the taxes, they distribute money to their investors, and it doesn't matter. They're like, here, you all pay the taxes. Doesn't matter. Here are your profits, pay the taxes. Well, that's not going to affect that kind of syndicate so much. What it's going to affect is the kind of syndicate that says, hey, let's buy real estate, let's buy a big building, then let's exchange into another property and exchange into another one and postpone those long-term capital gains. These larger, more potentially institutionalized investors are going to be much more incentivized to say, okay, well, rather than us buy a $20 million building, if we're going to have a 1031 exchange limit of, say, $500,000 on a property, why don't we just, or worse, per tax return per year, we don't know yet, we don't have the bill yet, bill won't probably be out for a few weeks, but anyway, if that's the case, then these larger institutional buyers might be pushed into buying smaller deals because it would give them the opportunity to slice and dice out smaller deals and just go, okay, it's 2022, let's sell a few single family houses for a total of $500,000 in gains and exchange them. Or if it's per property, great. It's a lot harder to get to $500,000 in gains in a single family or condo than it is on a big multifamily building. You get somebody going, hey, do I want I don't know, say 200 units worth $20 million in one building? Well, you're going to get $500,000 in gains really quickly. You'll be less incentivized to do 1031 exchanges. You'll be paying a whole lot more taxes. Or you divide it all up into single families. It's more work, but probably not for the syndicate anyway, because they're just going to hire a property manager. Property management rates are relatively the same, whether it's a single family or multifamily. In fact, sometimes you can get better deals on single family than you can on multi, because oftentimes there's less institutional competition for those single families. But what happens when all of a sudden single family homes, who today across the average are 90% of the time bought by people who want to live in the home? What happens when instead of 90% of people wanting to buy homes, all of a sudden, and live in them, we get only 50% of home buyers wanting to buy homes to live in them? Well, what that means is you've just injected a lot of demand into the single family and condo space for people to buy more single families and more condos, jacking up the competition again for single families and condos, making it even more unaffordable for the small-time buyer to get into real estate. This is very, very bad. It's toxic. Syndications and institutions that want a 1031 exchange and want to postpone taxes. Look at BlackRock, for example. These are companies that are going to continue to buy fixers. They're going to continue to buy single families. They're going to continue to buy what I like to call wedge deals and condos. And they will, in my opinion, transition to buying more of these instead of large buildings because the tax incentives say, fine, then we'll just focus on smaller deals instead of big deals. If you're going to get rid of the 1031 exchange, Biden, you're better off getting rid of it completely, because what you're doing is you're creating an imbalance. You're saying, we will give you a tax incentive if you buy small deals, but we'll punish you if you buy big deals. That's how simple this is. That's what's happening. The real estate market gets skewed by taxation, by government. Government screws the little guy again. Now, some people are like, but wait a minute, you get better scale with bigger deals. It doesn't matter. If you change the formula and you say you get a tax break at small deals and you don't on big deals, it changes valuations and demand until the market hits a new equilibrium. It's basic economics, and the basic bottom line is the little guy gets screwed again. So the first way the little guy got screwed is long-term capital gains going away for those making over $1 million, less incentive to sell your real estate. You may as well just either sell before the rule goes into effect. Great, maybe there'll be a little temporary boost in inventory, but in the long run, less turnover. You're going to see less people wanting to pay those tax bills, and you'll see that less turnover. 1031 exchange getting limited to $500K, more competition in the smaller space. And it also hurts people who are retired and have held on to the real estate for 20, 30, 40 years. And it hurts the little guy for their plans to be able to hold on to real estate for the long term. They'll be more likely to want to sell and incur those selling fees once they get to that $500K in gains, which again reduces their wealth because it forces them to make a transition when they didn't otherwise have to. All right, problem number 3 that comes up. So here's the thing. When you own real estate, you have a benefit to hold, but only for a certain period of time, because at some point you do something known as fully depreciate your real estate. That means the cost basis on your investment real estate has gone from whatever your cost basis was to zero. It just meant every month you took tax deductions until it was fully depreciated. Ordinarily, when you have a fully depreciated property, you'd sell it, 1031 exchange it into a bigger property, and then depreciate that new, more expensive portion of that new building that you bought. That's how you keep milking depreciation over and over and over again without being forced into paying taxes. Well, unfortunately, now with this 1031 exchange going away, you're stuck in a situation where once properties are fully depreciated, people are basically going to be forced or compelled to sell at the end of their depreciation curve, pay bigger taxes, but they'll be very likely to do that less often. Usual home ownership, usually people keep homes for 7 years. My guess is people are going to hold real estate even longer to incur those tax events less frequently. especially since you got selling costs to figure as well. To me, it's just another thing that screws the little guy, because this tax plan encourages people to hold real estate. The other downside, though, which used to be a benefit of holding real estate, the benefit of real estate used to be you could 1031 exchange over and over and over and over again, never pay taxes on your real estate. And then if you got hit by a bus and you passed your real estate on to your heirs would get a stepped up tax basis. That basically means if you had a $10 million portfolio and you depreciated it to zero, if you sold, you would pay taxes. Let's say you sold the day before you die, you'd pay taxes on that, and maybe you'd give the government $3 million in taxes, just as a rough example. If you died and then your family sold that real estate for $10 million the very next day, your basis would get stepped up from 0 to 10 million, which basically means your heirs would pay $0 in taxes, which means you would be able to escape taxes literally forever in real estate. That was one of the most beautiful things about real estate investing, is the ability to literally never pay taxes on your real estate. And this led people to, guess what? Invest in real estate. It led people to say, hey, we should keep investing in real estate. We should fix up real estate. We should buy and hold real estate, and we should 1031 and build our wealth through real estate. Well, now a big reason that people get into real estate, that stepped up tax basis for building a family portfolio, building family wealth, a big reason goes away. And this is not a big thing for massive estates. This is not something for people with $20+ million estates, because they're going to pay the estate taxes anyway. Like, that's where you'll get screwed on taxes anyway. When you have a portfolio over $20 million, you'll be paying the estate tax. But guess who doesn't pay the estate tax? People with under $20 million portfolios. So all of a sudden, a big benefit towards investing in real estate over the long run and having that stepped up tax basis to where you might never have to pay taxes on your real estate and be able to pass on to your family, to your kids, $1 million, a $4 million, a $5 million portfolio, all of a sudden goes away. That benefit goes away. Instead, your heirs would just inherit a big freaking tax bill when they go to sell that property, and the portfolio would be worth dramatically less, especially if they're selling really expensive property and there's no long-term capital gains. So again, you're not screwing the mega wealthy. The mega wealthy didn't really benefit from the stepped up tax basis that much anyway because of the estate taxes. The estate taxes would tax any amount of wealth passed on to the heirs above, whatever, $21 million or whatever for a couple anyway. Or 10 million, I think it's like 10.5 or whatever million dollars for a single person. But it's any portfolio under those numbers, under that 10 to 20 million, any portfolio under that size, which is like the very American dream, build a portfolio, get that $1-2 million real estate portfolio over time, maybe build it to a $5-10 million portfolio over your lifetime by starting small, buying your first house, buying a second one, buying a rental, buying a third rental, and building a portfolio. Those are the people who get screwed. Not the ones with the mega portfolios. They're already getting taxed. It's literally, again, the little guy gets screwed. Now, that could actually lead some people to just say, you know what? I just don't want to get into real estate anymore. And you might think, oh, that'd be good for inventory because that means less people are competing. No, don't kid yourself, because the institutional buyers will come in and they'll fill that void instantaneously because they now have an incentive to fulfill that void. They don't care about the stepped up tax basis anyway. That part doesn't matter. So the big guys are incentivized to fill any void, if anything more than that, and create more demand in the real estate market. The smaller family who's looking at real estate as a way to build wealth under the estate tax limits just loses a big benefit towards owning real estate. And guess what? Now potentially you disincentivize people from building wealth with real estate. Instead, they go YOLO options, lose a bunch of money, and guess what? They get screwed by the suits again. It's in this country. I am so sick and tired of it. It's always the suits and Wall Street that wins in almost every scenario. You tell them the rules and they will figure out the best way to win. But it's the little person who wants to build wealth who gets screwed by no incentive to hold real estate long-term. Long-term capital gains are going away for those, especially those medium-sized investors, real estate investors. That's going to lead to, again, more competition for real estate in the small deals, while at the same time having less inventory available because there's a disincentive to sell real estate for those people making over $1 million. That hurts people making less than $1 million. The lack of the 1031 exchange for anything over 500K hurts people trying to build generational wealth, which is sad. It hurts people trying to do that. It hurts people trying to buy and hold real estate. It hurts that retired person who held onto their real estate for 30 years and took care of that property and took the gamble on that property. That's the person it hurts. It doesn't help anyone. And again, the institutions will figure out how to play this game so perfectly that inventory will, you think inventory problems are bad now, they'll be even worse when institutions are incentivized to get into smaller deal real estate. And on top of that, the stepped up tax base is going away. Doesn't hurt the mega rich. They're getting screwed by the estate tax anyway. It hurts the small family trying to build wealth. Folks, there's literally no escape if all this crap goes through. This is bad. So in my opinion, here are the likely outcomes. Once this stuff becomes law, if it becomes law, you're going to see a wave of people trying to take advantage of the 1031 exchange right before all this becomes actual law, if it does. You'd think this would be a good thing because that means more people are selling, right? But it's worse because when you're doing a 1031 exchange, you also have to buy, which means by the end of the year, you're probably likely to see a big old buying frenzy, meaning more competition concentrated into fewer months in the winter, which is already a time you have less inventory in real estate if these rules go into effect, let's say January 1st. This distorts the real estate market and it props up real estate competitive even more. It's exactly why you want to go to metkevin.com/deals to find deals before they hit the market. And of course, check out my programs linked down below on real estate investing and other forms of investing and building your wealth, where I teach you all the secrets to building wealth in real estate and stocks and psychology of money. Use that 39% off coupon code linked down below. Now, long term, we're also less, look, short term, real estate agents will benefit. Real estate agents will get potentially a bonanza and people wanting to quickly rush to do 1031 exchanges. Long term though, remember, now there's an incentive to buy and hodl because it makes no sense to sell more frequently because you'll just have to pay, you'll have to have your date with the tax man more frequently. Which you could say, oh, well, you'll do that more often over time and you spread out your taxes. It's a disaster. People don't like looking forward to big tax years. I think this is going to incentivize people to not only hold their real estate longer, especially the smaller real estate investor, meaning, again, less liquidity for the real estate market, but it also means that people are probably going to skew towards a desire for newer construction real estate, because if they're going to hold their real estate for the long term, they may as well start out with newer real estate rather than older real estate. Like if I was going to plan to hold real estate for 27 and a half years, I would rather buy that real estate as a new construction build now than buy a 1950s place, remodel it today, hold it for 27 and a half years, and over time, I'm just gonna have to do more and more work. That roof's gonna come due, that plumbing's gonna come due if I didn't already upgrade it, that sewer's gonna come due if I didn't already upgrade it. I'd rather start with brand new. So you're gonna see more pressure on new construction real estate also. Okay, then we've talked about people holding longer, and we've talked about the middle class getting burned as corporate America comes in to take advantage of these 500,000 and under 1031 exchange rules. Folks, in my opinion, this is a complete disaster. These are really bad things for real estate. Hopefully they don't go through, because this is an extreme change for the real estate market. I mean, I don't even know what else to say other than check out the programs down below. Use that 39% off coupon code before Biden swoops in and takes that away too. Anyway, those are my more detailed thoughts on all of this nonsense that's going on. Thank you very much for watching. We'll see you in the next video. Bye.